G'day there, my name's Ben Everingham and I'm the director here at Pumped On Property, and in today's video I'm going to share why Brisbane is set to become the top performing market in Australia between 2018 and 21. Now this is exciting news for me as someone who's been following the cycle for quite a period of time. This is information in today's video that was released this week on the Australian or the ABC's website from a company called BIS Strapnell, who's the leading analyst and predictor of property price growth in Australia. They've been producing amazing reports for a long period of time. Very, very expensive reports, as you guys all know, but really good reports. And what I love about these guys and their data is, like me, they're super conservative. They generally try and do the right thing, and if you look back at their history, generally their reports have been significantly more conservative than the marketplace has actually performed. So I really like that about them. So what I'm going to talk about in today's video is what they've suggested about the Brisbane, Sydney and Melbourne marketplaces over the next 3 years. We're going to talk about the short term. We're also going to talk about the long term and the chances of any major short term correction as well. So in this article that they produced, which was, as I said, chucked on the ABC's website, Brisbane is predicted to be the #1 performing market in Australia over the next 3 years, according to their report and their research and their analysts. It is expected over between 2018 and 21 to grow by around about 13%, which is that sort of nice 4% growth per year that I like to achieve as an investor. Obviously, Brisbane historically has performed significantly better than that. In the last 20 years, it's gone up by over 8.6% per annum. Over the last 50 years, it's gone up by 9% per annum plus. But I'll take my 4% per annum over a period of time where, according to their research and analysts, Sydney is expected to only grow by 3% over the next 3 years. It may in fact even go backwards. I personally believe it could drop by anywhere as much as 5 to 15% in some instances down there. And the Melbourne marketplace is in a similar position where they're saying it should grow by about 6% over that 3-year period because of the really strong migration into Melbourne now and the undersupply of available accommodation. I also personally believe that they'll drop somewhere between 5 and 7% over the next 3 years in real terms after you take out inflation. So in terms of the short-term outlook, obviously there's plenty of sentiment around at the moment about how bad the Sydney and Melbourne marketplaces are, and that's causing a lot of people to sit on their hands. I love when people do nothing in a marketplace that represents good value still, particularly in Brisbane. You know, for anyone that knows their history, they know that Brisbane in the last 10 years, up until 2018, on average has only gone up by 0.9 of 1%, so less than 1% per annum over that period of time. So, you know, Sydney and Melbourne are definitely overcooked. Prices have risen by 80% there in the last 6 or 7 years. Leave those markets alone. But with more people moving over the border, the average income, according to CoreLogic in Brisbane now, is higher than the average household income in Melbourne. It looks really interesting. So in terms of what BIS was saying about the short-term growth, it's not going to be as strong as it has been over the last 5 years. For any of you that want to learn more about that, check out my video I just recorded called the 18-year property cycle explained. It goes into why Sydney and Melbourne have done so well, why they're going to do very average, I think, for quite a while now, and why Brisbane and some of the other markets should overtake it now. But, you know, in terms of this short-term growth, it's got to do with a few things. One is much tighter lending by APRA, which has been fantastic. It's pulled the brakes on the Sydney and Melbourne markets because that roller coaster was getting out of control. There's also, less and less interest-only loans being written, which means, you know, less people can afford to pay principal and interest on their loans. So that's another handbrake that APRA's pulled up. And then there's also been quite a bit of construction since the last GFC up until now. I think there was about 200,000 homes or dwellings constructed in Australia last year alone. Obviously the population grew by about 380,000 people. So, you know, that's good stuff. But at some point in time, some markets in Australia, probably towards the top of the next cycle, will be oversupplied because of all of the construction that's going to occur in Australia over the next 7 years. So in terms of the third thing I wanted to touch on, the chance of a major correction in the short term, according to BIS, is probably going to be mitigated by three things. One of those things is, you know, the ridiculously low interest rates. And remember that the Reserve Bank of Australia is giving money out for about, you know, 1.5 to 1.75% at the moment. The banks are still charging all of us suckers somewhere between high 3s to early 6s for our money. So there's still a nice big buffer there for the banks to start playing ball if they need to reduce interest rates for us. Remember that some places in America and Europe have been getting interest rates from their banks of 0%. Some of them have been getting interest rates from their banks at 2 to 3% for the last 7 years. So the Australian banks are still making record profits from the Australian property market because they're making a huge you know, profit margin on what they're lending or buying the money for and what they're lending it back to us for, which is nice. Like, I like when there's that buffer there because they can correct. We've still got some correction there if we need it from the Reserve Bank of Australia as well, where they can pull those rates down as well. So low rates are a good thing at the moment. It's a relatively stable economic environment at the moment. Employment rates are relatively good compared to other times in history. We've also got ridiculously strong population growth at the moment, which the government's obviously just opening up the borders to stop that Sydney and Melbourne bubble bursting there. But, you know, more people coming in with more money, needing more jobs, more services and buying more stuff is good for the overall Australian economy long term. You know, maybe not short term, but long term. So, you know, we're in a relatively stable economic environment at the moment. You've got to remember that the major reason prices in Sydney and Melbourne are declining a little bit at the moment is probably because they've gone up so freaking much over the last 7 years. And if you know your history, every time we go up by that amount, you get that winner's curse, which is the last 1 to 2 years at the end there, where people buy in for more than it's worth because they're scared of missing out, and then prices adjust a little bit once that demand shifts. But the real reason for the demand shift has been changes to international buyers. It's also been APRA putting the handbrake on and going, enough's enough. We're going to slow this thing down before it gets too bad. Or too much of a bubble and the bubble pops. So I hope that Sydney and Melbourne do absolutely nothing, like BIS has said, for the next 3 years. In fact, I hope they do nothing for much longer than that, so it becomes affordable for people again and people can start having quality of life down there. Brisbane, on the other hand, according to BIS, looks really interesting. If you're interested in that stuff, you can just sort of search BIS Strapnell plus housing market outlook. You can look at Heron Todd White's report and get an idea of where Sydney, Melbourne and Brisbane are at in this stage of the cycle each month for free. CoreLogic does a great update on this stuff, and you know, all three of them are pretty much in alignment at the moment with what they're saying. So from 2021, and this was the last thing BIS Strapnell sort of commented on, they believe that we'll have got through this period of what could be determined as the mid-cycle slowdown, according to Phil Anderson, where Sydney and Melbourne come back a bit. You know, places like Brisbane start coming into their own a little bit. The share market could get a bit of a hit in the next couple of years at some point, or maybe the next 3 years. But, you know, I think there's buying opportunities when there's people sitting on the fences with this sort of stuff as well. Not in Sydney and Melbourne, like just avoid those markets, they've topped out. But particularly in Brisbane, where it has been flatter for such a longer term period of time. So, you know, according to BIS, from 2021 forward, things are going to start to really heat up in certain marketplaces, probably not Sydney and Melbourne as much, but some of the other major capital cities and metro or major regional markets, because of population increasing by, you know, probably at least another 300,000 people per year for the next 3 years, which is going to create very, very strong demand in the property market. You know, supply will continue to be, you know, undermet, I think, at the moment, based on the planning policies in Sydney, Melbourne and Brisbane, which is where 75% of the population growth is expected to occur, according to the Australian Bureau of Statistics. and sort of better economic conditions from about 2020-21 forward. So I think that's positive stuff, you know, in a marketplace where Sydney and Melbourne are starting to go backwards. You've got these opportunities that start presenting themselves in places like Brisbane as people go, I'm just sick of, you know, my cost of living being so high down there, and they start this mass wave of migration into Brisbane, which I think is going to begin to occur in a heavy way over the next 4 or 5 years. I think the outlook over the next 7 years in Brisbane is exceptional, and I hope you guys are watching this video back in 7 years' time going, holy shit, you know, I should have bought into Brisbane at that time, which is sort of what I was saying 5, 6, 7 years ago in the Sydney marketplace. So I wish you all the best with your investment journey. For those of you looking to get a hand buying into the Brisbane market, I'd love to learn more about where you are and where you're looking to go. We run a buyer's agency that's helped buy over $200 million worth of property now in the Brisbane and Sydney marketplaces. I'd love to offer you a one-on-one strategy session, which myself or my brother Simon will go through with you. Just jump over to www.pumpedonproperty.com and hit free strategy session, and let's talk about how you can make the most of the current economic environment and, you know, make sure you get yourself really strong property with that long-term potential. You know, while I'm sharing what's happening in the next 3 years, according to BIS, shrapnel, I really don't care as a person that looks at investing as a 15, 20, 30 year thing. You know, I like to buy the dips, the sentiment dips as opposed to the market dips, which I think we're in right now and should be in for the next sort of year and a half. There'll be a lot of people sitting on the fence because the Daily Telegraph is freaking them out, but smart investors will be buying really high quality property at great prices in the Brisbane marketplace. And then as that sentiment, demand and population growth continues to kick into gear, I think it's going to be very, very positive outlook from about 2022 forwards until we get to, you know, whatever's coming after that. So really looking forward to continuing the conversation with you guys. Please feel free to like this video, subscribe to our channel. I try and produce somewhere between 3 and 5 videos a week. We've done heaps of them. A really cool one to check out is that the 18-year property cycle explained, if you like this one, or our 2 properties to financial freedom video, where I explain how you can actually set yourself up for financial freedom in just 2 properties over a 15 to 20 year period of time. You know, we're not the get rich quick guys, we're just the consistently work towards your goal and give yourself choices that you don't currently have today when you really want them most for yourself and your family. So good luck, and thank you so much for your attention and your time. Bye.